Welcome to vTalkInsight, Market Drivers Daily for August 3rd, 2026. Today, a rare joint intervention in the yen, a sharp pullback in oil, and a reset in AI capital spending narratives are reshaping cross-asset risk and reward. Let's dive straight into how the evolving AI story is intersecting with credit, earnings, and global equity leadership. The artificial intelligence trade is shifting from a simple bet on U.S. hyperscalers to a more complex, global, and selective theme. Capital expenditure on data centers and compute remains intense, but markets are now rewarding clear evidence of demand, cash flow, and return on that spending rather than AI headlines alone. That makes the quality and geography of AI exposure far more important than it was earlier in the cycle. Recent advances from Chinese platforms are a key challenge to U.S. dominance in AI models. Alibaba's latest flagship model, which is marketed as matching or beating global peers, has driven a strong rally in its shares and lifted sentiment toward select Chinese tech names. More broadly, the rise of competitive Chinese models raises the prospect that AI-driven equity gains may become more globally distributed, supporting a constructive view on international markets, particularly in Europe and parts of Asia outside China. Under the surface, the AI value chain is broadening from infrastructure to adoption. Cloud businesses at major hyperscalers are still posting rapid growth, pointing to ongoing and possibly accelerating capex on servers, networking, and power infrastructure. At the same time, companies like Palantir and Stagwell are reporting strong AI-related revenue momentum, while upcoming results from Siemens Energy and Infineon will test how durable AI demand is for data center equipment, semiconductors, and electrification plays. Funding the AI build-out is increasingly a credit market story. Infrastructure funds focused on data centers and digital assets continue to attract capital, and hyperscalers are expected to grow from roughly 1/20th to perhaps a 10th or more of the investment-grade bond universe as they finance long-term projects. But investors are demanding clearer economics from AI spending. Loan buyers are pushing for better terms from highly leveraged tech borrowers, while heavy issuance from AI and data center names adds to long-end yield pressure and raises the cost of capital for marginal projects. There's also a growing counter-narrative around AI exuberance. Private market enthusiasm for frontier model firms is cooling as cash burn and IPO expectations are reassessed, and a recent forced deleveraging in crowded AI trades triggered a drawdown of more than 20% in semiconductor benchmarks, particularly in Korea. Investors are increasingly distinguishing between durable cash generators and speculative stories, as highlighted by rotation into quality tech and AI names with stable earnings and away from highly valued smaller players. Looking ahead, the key watch points are upcoming big tech and European industrial earnings, policy signal from this week's White House AI meeting, and whether market leadership broadens toward AI adopters in sectors like financials, healthcare, and industrials. All of this is playing out against a rapidly shifting energy and geopolitical backdrop. Geopolitics remains a dominant macro driver, but today the tone is tactical de-escalation rather than fresh escalation. Oil prices have fallen sharply, with Brent down around 5 to 7% as prospects for renewed U.S., Iran talks, and canceled military strikes ease immediate fears of a wider conflict. That drop is filtering through into softer inflation worries, a rebound in equity futures, and outperformance in fuel-sensitive sectors such as airlines and travel, even as energy majors and FTSE-heavy oil names come under pressure. Even so, the geopolitical premium in crude remains substantial. Flows through the Strait of Hormuz are gradually recovering via shuttle tankers and ship-to-ship transfers, but volumes are still well below pre-conflict levels. Talks mediated by Oman on safer passage have reportedly made progress, yet Iran denies direct negotiations with the United States, and its influence over the choke point has increased, keeping asymmetric risk to energy supplies elevated. Fundamentals provide a mixed picture. On one side, strong production from North and Latin America and evidence of demand destruction in Asia, particularly China, have kept the market better supplied than many feared, anchoring expectations that prices may trade in a broad $75 to $90 range rather than spiraling higher. On the other, structural shifts such as China moving from drawing down reserves to boosting imports, plus ongoing conflict in Ukraine and Russia's extended diesel export ban, underline that supply shocks can reappear quickly. Europe adds another layer of complexity through climate-driven disruptions. Record low water levels on the Danube and Rhine are hampering shipping and commodity transport, while low river flows have forced nuclear plants in Hungary and France to cut or halt output, tightening power supply and driving electricity prices higher. Combined with higher shipping costs, refinery bottlenecks, and wildfires, this mix is intensifying stagflation risks in parts of Europe and weighing on regional valuations and margins, even as some export-oriented and AI-linked sectors look better positioned. Policymakers face difficult trade-offs in this environment. The Bank of England is seen as reluctant to tighten further unless oil spikes again, yet renewed energy inflation could force action into a fragile domestic backdrop, with potential downside for sterling. Across the euro area, political strains over migration and border policy ahead of elections add another source of uncertainty on top of energy and climate shocks. For markets, the main questions now are whether diplomatic efforts can lock in a more durable easing of Middle East risks, how quickly tanker traffic through key straits normalizes, and whether European logistics and power systems can cope with continued heat and drought. The answers will feed directly into the volatility regime now emerging across rates, currencies, and equities. Cross-asset volatility is no longer just an episodic shock. It is becoming a structural feature of this regime. Real U.S. yields are back at levels last seen before the global financial crisis, while markets are losing the comfort of predictable central bank guidance that dominated the past decade. That combination is amplifying the impact of geopolitical headlines, AI-related flows, and currency interventions on both bonds and equities. The standout development is the rare joint intervention by the United States and Japan to support the yen. Authorities reportedly sold tens of billions of dollars in U.S. treasuries, driving the yen sharply stronger toward 156 per dollar and jolting global bond markets. With speculative short positions in the yen at extreme levels and policymakers signaling readiness to act again, traders are reassessing assumptions about free-floating currencies, adding another layer of uncertainty to yield curves worldwide. At the same time, the Federal Reserve is stepping back from heavy forward guidance. Discussion of cutting the number of policy meetings, coupled with unclear communication after the last decision, has pushed markets toward a more data-dependent and less predictable framework. Demand for bond market put options has jumped to levels reminiscent of past stress episodes, while many investors are rotating into short and ultra-short duration bonds to manage heightened interest rate volatility and duration risk. Equities are experiencing their own version of this volatility, even if headline indices appear resilient. The Philadelphia Semiconductor Index has suffered a drawdown of over 20%, the largest since the late 2000s, following a leveraged unwind in AI-heavy positions. South Korea's Kospi has given back a notable part of its recent surge, and large-cap tech stocks continue to see outsized market cap swings around earnings, reflecting crowded positioning and very high expectations. In credit, single-B leveraged loans now offer high single-digit yields as spreads widen, partly due to concerns about direct lending, software disruption, and concentrated AI exposure. There are, however, counterpoints to the fragility narrative. Many market participants still view recent moves as a reset in pricing rather than the start of a broad bear phase, noting that equity markets have rebounded on strong AI and hyperscaler earnings, and that energy price shocks are interacting with inflation less violently than in prior cycles. What happens next will hinge on several catalysts: upcoming U.S. non-farm payrolls and inflation data, further signals on Fed meeting frequency and communication style, any additional yen or FX interventions, and the tone of credit issuance tied to AI and infrastructure. Together with the AI and geopolitical dynamics we discussed earlier, these developments point to a world where volatility is likely to remain elevated, putting a premium on robust risk management and scenario analysis rather than reliance on a single baseline. To wrap up, the AI trade is evolving into a more global and selective phase, where balance sheet strength, credit access, and clear return profiles increasingly separate structural winners from speculative stories. Geopolitical tensions have eased tactically as U.S. Iran rhetoric cools and oil prices retreat, giving temporary relief on inflation, but structural energy, climate, and supply chain vulnerabilities remain, especially in Europe. Across assets, a rare yen intervention, shifting central bank communication, and crowded positioning are embedding a higher volatility regime in bonds, FX, and key equity sectors, even as headline indices hold up. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.